Good day, everyone. Thank you for joining me. My name is Undertaking. Today, I'll take you through Philip Morris Q2 results for FY21. In this presentation, I'll briefly discuss the results, which were somewhat decent. We had an earnings beat, but revenue was a miss. I'll also go through a valuation on the company and discuss why we're maintaining an overweight call on the stock. On the 19th of July 2021, the company released Q2 results for FY21. In these results, PM recorded an adjusted EPS of 157 cents, up 21.7% ahead of estimates. The beat was largely attributable to favorable currency swings and slightly higher EBIT margins. Key features included continued growth momentum in tobacco-heated products, though combustible market share remained under pressure with modest pricing. PM increased its guidance by 0.5 percentage points for the revenue and by 1 percentage point for EPS, targeting a midpoint revenue and EPS growth of 6.5% and 13% for the full year. When we further dissect the results, starting with the top line, our net revenues were up 14.2%. When we exclude currency, the revenue was actually up 7.9%. We also note that for the quarter, management has guided that up to date, the IQOS users in terms of volumes have actually increased to approximately 20.1 million in total, of which 14.7 million have switched to IQOS and stopped smoking a ordinary cigarette. When we combine the cigarette as well as tobacco-heated products shipment volume, the volume was actually up 6.1% for the period. Of the cigarette shipment volume was only 3.2%. Overall market share for the tobacco-heated products was up 1.4 points to arrive at 7.3%. Following the release of the results, the share price was down 3.1%. When you look at how the share has performed since our last recommendation in February, the share has actually outperformed the benchmark. It's been up 15.8% since the 19th of Feb, while the benchmark has only been up by 10.3%. On an earnings basis, EPS estimates for FY21 rose steadily as management increased the full-year adjusted outlook, with organic net revenue expected to grow at 6% and adjusted diluted EPS expected to grow between 12 and 14% on the same basis. And this will be reflective of the improved total industry volume. Further to this, management has also announced a share repurchase program of up to 7 billion USD. In the slide, we show the impact of the share repurchase program on the full year outlook of EPS. So what we see on this table is that when we smooth out the 7 billion total that is to be spent on the repurchase program over a period of 3 years, the effective impact on the EPS is actually 7.7%. So if we take this and subtract it from the guidance of 13% EPS growth for the full year, we are left with less than 7%, that will actually come from organic growth or organic activity outside the share buybacks. On a forward PE basis, the counter is attractively priced at a forward PE of 15 times, reflecting a discount of 11.1% to its long-term average of 16.9 times, and it's trading at a 28% premium to its FTSE peers. While it's expensive relative to the peers, we maintain our overweight recommendation on the stock, and this is because we see it as a quality company with strong cash conversion and a decent balance sheet, and I think this is evident in them being able to buy back shares. But also the company has a first mover advantage in terms of risk reduced products, which is where your ICAS would fall in. But we just have one concern, and this is with regards to the price mix in the cigarette space. And this is on the back of tax issues in Germany and Australia. But outside that, we are bullish on the stock. If you would like to place a trade with us, please speak to your financial advisor or contact the dealing desk. Additionally, a full report on PM can be found on MyBase. Please enjoy the rest of your day. But before we end off, please take note of the following disclaimer. Thank you for your time.